Chapter 13 starts the discussion of current liabilities, and we're going to look through several types of current liabilities. We're going to look at more financing type of current liabilities, as well as current liabilities related to operations of the firm, and also look at some of the tax implications that arise from payroll taxes and allocating payroll correctly. So those are the basic types. We're also going to talk about contingencies, which is typically a long-term sort of liability, but may also have some current pieces. But we're going to talk about how to record warranties, which are a type of contingency most commonly faced by firms, as well as how to record more special sorts of contingencies like lawsuits and whatnot, product recalls. So at a conceptual level, liabilities, again, are going to be probable future sacrifices of economic benefits arising from present obligations to transfer goods or services or money, assets. They need not be payable in cash, so we can refinance outstanding debt. We could be obligated to provide services. They don't have to be items that they don't have to be an event that has even occurred. In fact, we could still be waiting for an event to occur, so warranties would fall under this umbrella. Also, contingents. So as I mentioned, lawsuits and other sorts of massive events like product recalls. Timing of the payment does not need to be known in all cases. In contingent cases, we are not exactly sure about time of payment. In AROs, again, we are estimating the time of payment. So that's kind of some of the issues that can arise when we're talking about liabilities, or some of the interesting parts of them. So more specifically, even though they're thought of as things that are coming due within a year, we're going to be thinking more along the lines of whether we're settling with current assets or creating new current liabilities. If we are refinancing debt with long-term debt, then it would become long-term debt. So a key part of this definition is if something we're going to settle by paying an asset or creating new current liabilities, that's a current liability. If we use a long-term liability, it becomes the long-term liability in the refinancing. Current liabilities are considered more pressing, more risky because they're of immediate concern to the firm. We're mostly going to be valuing them at maturity amounts rather than their present value. Because they're short-term, we don't typically take in the effect of interest when we're establishing just its overall value on the balance sheet. If they can, under circumstances, they'll do a discounted cash flow approach, and also there'll be non-interest-bearing notes that we will account for with the present value calculation, or at least what we call discounting at issuance. The type of notes that we have as current would be accounts payable. Remember, these are open supply lines with those who bring us goods. We can pay them in a short-term window, typically less than 90 days. If we record these at the gross method, we record them at their full amount until we pay within the discount window. And then if we record them in the net method, we assume we're going to take advantage of that discount, and we record them net of the discount as the payable themselves. Notes payable are going to be something that you see generally for a financing agreement with a bank or another short-term formalized loan. These are more formal than accounts payable, which are just sort of understandings between businesses. They're more similar in substance to long-term debt than they are to other accounts payable, just because they can be refinanced rather than paid off. If they have the intent and ability to refinance these loans into a maturity beyond a year, again, remember that means that they're going to be reported as long-term liabilities when they're refinanced with some other sort of long-term item. There are secured types of loans. These loans are going to have some sort of collateral pledged so that it ensures the lender that if you default on payment, they have something they can seize. Commercial paper is a special type of loan where typically going to just put it under the notes payable umbrella, but these are unsecured notes that have minimum denominations of $25,000 and a pretty short payment window. so typically less than a year. They are discounted at issuance, similar to a non-interest bearing note. We're going to look at that process of discounting these guys at issuance. And it's going to be a little different just because we're talking about, again, something that is less than a year. So we're going to have to appropriately adjust the interest rate. Typically, they're going to be financed with a line of credit backing them, which means that you're guaranteeing payment to the lender through the bank that you are backing. And this is kind of an interesting note that this was a market that froze up during the 2008-2009 crisis and really exacerbated the situation when banks were loaning companies and other banks commercial paper, and that market froze up because all of a sudden we didn't know who was going to go down next. You can imagine that there's a lot of financing that was tied up, and that's why they were worried that the contagion would spread so quickly. Credit lines are mentioned here if you're backing a commercial paper instrument with lines of credit. And these are just relationships between companies and banks where the company can draw upon an amount of money without going through the formal loans and stuff. Committed lines of credit call for annual fees and a compensating balance. Non-committed lines of credit are less formal. They still may require a compensating balance. Compensating balances are usually pretty low because the principal of the borrowing is usually very high. So this just requires the person that is asking the line of credit to have a compensating balance at the bank. It's almost a way of paying interest to the bank because it increases the amount of money they have to lend and decreases your amount of money that you have to operate. And it's part of kind of paying down on the note. But anyway, that's a sort of a theoretical aside. Cash received from issuing notes, all of that stuff, consider a financing activity. But if we're talking about the payables, the current payables, right, those are income from operations or cash flows from operations. So we would have to adjust adjust net income by reversing any accrued expenses. That would be in this cash flow from operating activities section, of course. Right? So those are mostly types of financing things. Now we're going to start talking about these operating current liabilities. The operating current liabilities are a lot of ones that you've already seen: wages, salaries, taxes, interest. Another special type that arises that you may not have seen yet is a compensation payable that would arise from maybe compensated future absences like sick days. And there's some criteria that follow those that just establish the existence of an obligation on the part of the employer. Advanced collections from employees and customers. So if you have any refundable deposits, if you have anything that you're taking from your employees that will be paid back in a future period, that is going to be recorded as a liability into collection. So in the case of taking things from your employees, it's not really taking so much as just holding, right, for them. Social security withholdings and any sort of tax withholdings. But mostly this deals with items that are withheld from paychecks, and we'll look at that in a bit. And then also you have things that you could have a refund liability for customers. So if they take some equipment from you, you have them put down a certain amount of money, that's a refund liability. And then finally, if there's a forfeited deposit, you record it as revenue. And also you would have an adjustment to your inventory for any lost items to the forfeiture. So for example, if they had to return something, and if they didn't return it, then they would have to pay the deposit. Then we would also have to show that we lost some of our inventory that we are putting out there with refundable deposits. Advances from customers could be gift cards, unearned service revenues of any kind. Remember that these would be considered current unless they are definitely going to be settled in the long term. Also, whenever you're dealing with these, you have to remember that there are certain policies that companies can adopt where they can recognize breakage income from gift cards over a short-term basis. So, for example, if it's been X number of years since the gift card has been outstanding, then they can go ahead and recognize revenue in certain cases. They just have to describe it in their footnotes. Collections for third parties, again, sort of going off of collecting items from our employees. Sales and payroll taxes are liabilities until we remit them to the appropriate units. So there's going to be a sort of dichotomy we're going to make between what is being paid by employees and what is paid by employer. And we'll see how that will sort of factor into how you're going to account for this stuff. Essentially, anything that's paid by employees, you're going to have as part of your expense. And then credited as specific payables. And then anything net of all those payables becomes the net pay of employees. So if you think about it, you have all those withholdings from any one of your paychecks. Well, they're going to be part of salary expense credited as specific payables. So all that Social Security that my job doesn't give to me in terms of pay is held by, for example, the University of Colorado, and then paid to the government on my behalf, right? So University of Colorado credits it as a payable until they pay it over. So all those things that are withheld, then I get my net pay. That's going to be salaries payable. And we'll see how that works in a problem. The ones that are paid by the employer become payroll tax expense when they are related to taxes payable. So this will be matching Social Security benefits, matching Medicare benefits, with the withholdings from the employer or the fees paid by the employer for the unemployment taxes at the federal and state levels. And then there'll be another charge for salary expense for any fringe benefits. And we'll see what happens with those. So lots of fun coming in with the payroll taxes. I would like to go over this small example, which has multiple entries. And the entries will help with the idea of using and documenting a short-term payable because, we're talking about current liabilities. So the financing is a little different when you're not talking about a full year. It might seem a little strange at first. So in this example, we just have three items going on and multiple entries for each item. When we are opening a line of credit, as we are on July 1st, we don't have to really record anything for this particular transaction. It's just documenting the existence of one. Doesn't mean we haven't actually exchanged any cash. We haven't encumbered any obligation. We just now have $25 million that we can draw on at this moment at 11.5% rate. There's no commitment fees, so there's nothing for us to show as a fee and credit cash. So we don't need to make an entry on this date. On August 9th, we receive a $30,000 refundable deposit for copper-lined mailing containers used to transport communications equipment. Now, this would have a journal entry. So we have a $30,000 refundable deposit. We receive cash of $30,000, but that's not ours to keep, so we have a refund liability of a similar amount. Received most of the mailing containers covered by the refundable deposit on October 17th, 2016. It says that they have a letter stating that they will retain containers represented by $2,000 of the deposit, and they forfeit that amount. So Now we're getting rid of this refund liability. We're settling it up, and it's coming back to us in two ways. The first way, of course, is the fact that we are using $28,000 of cash. We're returning $28,000 to our customer. The refund of liability is wiped out in its entirety, and then the $2,000 that they retained would then be revenue deposit forfeited. So essentially, we kept $2,000. Now we can treat it as revenue because they forfeited the deposit. Now we have to make the adjustment to our cost of goods sold in our inventory, because we know that the cost of the forfeited containers is $1,500. So we've lost $1,500 worth of inventory, and we would have to record that as an expense to cost of goods sold. The next item, we borrowed on November 1st. We borrowed under the credit arrangement. Interest is due at 12%, payable at maturity. So on 11/1, we borrowed $7 million. That's going to create a note payable at 12%. But it didn't say anything about discounting. It didn't say anything about a market rate. We don't typically do market rate present values because they are short-term current liabilities. But typically we will say something like in the next problem you'll see it is discounted. It is a 12% interest payable at maturity. And maturity on this guy is 9 months. So it'll come due in the next year. But we do have to make an adjustment for interest expense at the end of the year. Because this note has been accruing interest for 2 months. So that'll give rise to an interest payable that we have to recognize at 12/31. And that interest payable would be the $7 million times 12%. Times 2 out of 12, which should come out to $140,000. Okay. Then the next one, we have an unused portion of our line of credit that we're now using. This is in 2/2/17, so this is a new year. So we have $9 million of commercial paper. Interest is discounted at issuance, so we're going to receive less than $9 million, and it's at a 10% discount rate. That's an annual rate. So in order to figure out the discount, how much we actually get for this note, it would be the full amount, $9 million, less whatever the discount is. And we're going to figure out the discount by taking $9 million, multiplying it by the 10% rate, and adjusting that 10% rate for the fact that we are only going to have it for 9 months. I'm sorry, this is not 9 months. This is actually a 6-month note. So it's going to be discounted by that amount and then reduced by half because it's a 6-month rate. So in order to get that, you would take $9 million. That would be $900,000. 900,000 times a half is $450,000. That's the discount. And the amount of cash we would have extended would be $8,550,000, and we would have a note payable for $9 million. All right. The next item that happens is that we paid a 12% note at maturity on 8/1/17. And we are paying off the note that we don't have a discount on. So we have the note payable we took at a 12% rate. Interest is due in 9 months. First thing we could do is just reverse the note payable entry for $7 million with our payment of cash. Now we also have interest of 12% due at this point. So what is the total interest due? It would be the $7 million times 12% times 9 out of 12 because it's a 12-month note. And so the total interest would accumulate to $630,000. Now we've already recognized interest expense of $140,000, and that's part of the payable. So when we pay this off, some of it is going to be interest expense that we match to this period because this note's been accruing interest from January all the way up to August. Some of it will be the interest payable that I have already recorded because this is an amount that I'm going to have to pay at maturity, but I had to match the expense to 2016. So I reduced that payable amount. The expense is going to be the difference between the amount of cash I have to pay, which is the total interest expense I calculated, and the difference would be the properly matched expense. And you can check that if you need to. You can just say, all right, well, what is 7 million times 12% times 7 out of 12? Because that is the January 2017 to August 1st, 2017 interest that we just recorded. All right, and the final item is that we paid off the commercial paper that we borrowed in February. So when we pay this off, we're going to have a note payable being paid at $9 million. And we're also going to have to recognize that the discount is gone. And remember, when you amortize the discount like this, you're recording it as interest expense. And again, that makes sense because we borrowed $8,550,000 and then had to pay back $9 million. So not only did we pay off the principal amount, but we also paid an amount of interest, right, in cash. Right, cool. So that is how you would record these items. Again, it's familiar but a little different from what you've done before simply because we're talking about such short periods of time. Notice we're not using a present value calculation in these particular examples, and that we just adjust them accordingly by the fact of adjust rates accordingly due to how much time that each one will be out. It's just going to be a little different. All right, we will pick up now with an example on payroll taxes. Now, again, these are going to be a little tricky at first, just in terms of allocating everything correctly. Like I said, it really helps if you treat each one as if what is the employer going to be paying and what is the employee going to be paying. So the federal taxes that are going to be withheld are going to be paid by the employee. So I'll just make 2 columns. Paid by employee and paid by employer. Federal taxes are going to be paid by the employee. State taxes will be paid by the employee. Now we have a split here with the third guy. 70% is paid by the employer, which in this case is $700, and 30% by the employee, so that's $300. The employee pays out an investment contribution, which is matched by the employer. The union dues are going to be paid by the employee. The life insurance is paid by the employer. The Social Security tax is going to be paid by the employee and matched by the business. Same thing with the Medicare. Then the employer is going to pay the federal unemployment tax and the state unemployment taxes, right? So now you have a sort of dichotomy of where things are going. You go down here and you start with recording your salary and wage expense. Now this is going to be the full amount. We're just going to break it out, take out everything that would be paid by the employee as a payable. So the business realizes there's $100,000 of expenses. One of those is going to be federal withholdings. State withholdings. So these are things that the employer is going to pay on the employee's behalf but the employee pays it because they don't receive it as pay. Like we're garnishing their ultimate pay, right? Now we have a payable to Blue Cross because the employee will let you make that payment on their behalf. Same thing. Now we have another one with the Fidelity insurance. The employee is sacrificing some of their pay for an investment. They also are going to put their union dues in here. And finally, Social Security tax, Medicare tax, both of these payable. Oops. Now, the final item is salaries and wages payable. So salaries and wages aren't as easy as it seemed in Intermediate 1 to calculate because there's a lot of other payables involved with this. So then you just take the net of all of that, which comes out to $64,950. So this is what the employees are due to receive. This is what we're holding and going to pay on their behalf as the company. Now, the company has payroll tax expense. In other words, there's taxes paid by the company. They match Social Security benefits. They have the Medicare tax payable. Then they also have these other taxes that they're going to pay, the FUTA payable and the state unemployment payable. So they match the Social Security, $6,200. They match the Medicare. Then they pay their FUTA, which is $600, and the state unemployment tax. And so that's going to add up to create more expenses for the company to pay that are not part necessarily of the salaries and wage expense, right? They arise from it, but they're payroll taxes. So that's $13,750. Then finally, the fringe benefits are going to be an added thing to salary and wage. We're not taking them from their pay, so that's why we book it separately. These are the fringe benefits. The fringe benefits would be that we pay their life insurance, payable to Prudential for $200. We also match their Fidelity for $4,000. And then finally, we pay their medical insurance premiums. So we have a payable to Blue Cross for 70% of that. Which comes up to $4,900. So you take everything the employees pay and then set up this journal entry, take everything that the companies pay and set up 2 journal entries, whether it be a tax they're paying or a fringe benefit they're paying. Right? So I'll stop it there. It's already pretty long. And this is what we'll talk about on Monday.